Bond yields are moving higher on the back of today's jobs data. The 2-year was up like 20 basis points. Let's get to Rick Santelli at the CBO for more. Rick, Steve and I were talking earlier. Is it a bull flattening, a bear flattening, and earth flattening? What do you make of it?
Yeah, well, I'll tell you, a 2-year note closed at 356 last Friday. A 10 closed at 375. So the numbers are staggering. Listen, the flattening led by the short end is something to pay attention to. We've gone up half the steepening. Jim Bianco, here you are. Thank you for coming to Chicago. You live in Chicago, but coming to the exchange. What did you think of today's numbers? They were just talking about the big moves in yields.
You know, every way you cut it, the numbers were very, very good. You know, the job growth was good. The wages were strong. There was no birth-death model jobs that were created. So when you sum it all up, it was a very good report.
Part-time has been the, mantra of much of the job creation of late. There was definitely some full-time within this report.
Yeah, there definitely was. You saw some full-time numbers, and that was very good as well. So when you sum it up, I understand the bond market move, because all of a sudden now the 50 basis point cut we were looking for in November seems to have all disappeared, and now we're down to 25 basis points.
Yep, and bear flattening, as we were just talking about. Now, the other thing that I think we need to merit some discussion is, how does this affect the Fed? Okay, many believe that it should be a one and done now, or the market's view is 25 and 25 for the last couple of meetings.
You know, before the number, I thought that the Fed was already going to be in a difficult situation because we had strikes. We got the port strike resolved, but we still have the Boeing strike. We've got flooding in North Carolina and South Carolina and Georgia. That's going to be a big problem. And that the economic data was going to be very muddy as we go forward. And to err on the side of caution, they were probably looking at a 25 basis point cut anyway. Now that you throw in this big number, it all but pretty much cements it.
Now, real quickly, while we're still talking about this report, hours worked was the lowest. To find a lower number than the 34.3, you have to go to March of 2020. That was last month. This month, 34.2. Now, that's March of 2020 to find a smaller work week. That does take a little of the positive zing off all the other metrics, does it not?
Yeah, there's a bit of an offset there. You know, when hours work go down, you tend to see more jobs. When hours work go up, they tend to hire less people as well. So if hours work went down and you hired more people, if that rebounds next month, you might see a depressing number of people that are employed.
But it actually might make the wage numbers look better. Less hours and wages going up, that's pretty impressive.
Yes, that does. And in the world that we live in, where we're worried about 1/10 on the wage numbers, it does matter.
Okay, now, next week, CPI and PPI. I've thought all along, if we continue to bump along between 2.5% and 3% and we get a couple of odd months that go higher, the Fed's going to be between a rock and a hard place.
Yeah, they are. And if we're down to looking at monthly numbers, there is a residual seasonality in the CPI number and PPI. Residual seasonality just means that the seasonal's affected. The seasonals are very positive now at the end of the year, so that could just skew the numbers higher and really put the Fed behind it.
Now, I'll make another quick prediction. Next week, not only we have CPI and PPI, we have 3s, 10s, and 30s. So we have the long end auctions at a time where the 10-year is within spitting distance of 4%. It's going to refocus on the debt and deficits. Well, next week could be a big week for interest rates.
After the move this week, usually you get some kind of follow-through one way or the other.
Excellent.
Agree.
Jim, thanks for joining me today on the CBO. Brian and Kelly, back to you.
I could be a Brad, kind of. Thank you very much, Rick Santelli. All right, sure.